Imagine if you could build wealth without spending hours analyzing stock charts or trying to predict the next big company. What if there was a way to grow your money with less stress and with more consistency? Well, there is, and today we're diving into one of the biggest debates in investing: index funds versus individual stocks. By the end of this video, you'll know exactly which approach fits your financial goals and how to get started. I don't know about you, but investing can feel pretty overwhelming, especially with so many options out there. A lot of people avoid investing because they're scared of losing money, but the truth is, not investing is often riskier. With inflation eating away at your cash, keeping all your money in a savings account can actually make you poorer over time. That's why understanding how to invest smartly, whether through index funds or with individual stocks, is so important. So, should you pick individual stocks like Warren Buffett or keep it simple with index funds like the pros recommend? In this video, we're going to break down the pros and cons of each strategy so that you can make an informed decision and start building wealth the smart way. Hi, I'm Greg Hardy, and welcome back to the channel where we talk about all things personal finance, investing, and building a financially secure future. If you're passionate about taking control of your finances and learning something new every week, subscribing is the best way to stay connected. One click helps grow this community and also brings this knowledge out to others who need it. Thank you. Index funds are a simple and effective way to invest in the stock market. Instead of buying individual stocks, an index fund lets you buy a small piece of every company in a specific market index, like the S&P 500, for example. Think of it like a sampler platter. You get the taste of everything without having to choose just one dish. By investing in an S&P 500 index fund such as VOO or HDF&x, for example, you're instantly spreading your money across 500 of the largest U.S. companies. This reduces your risk compared to buying individual stocks while still offering solid long-term returns. This approach makes it easier for investors to spread their money across many companies with a single purchase. One of the biggest advantages of index funds is diversification. By owning a wide variety of companies, you reduce your risk overall. If one company's stock struggles, the performance of the others can help balance it out. This makes index funds a more stable and predictable investment compared to betting on just a few individual stocks. Index funds achieve this diversification by holding dozens or even hundreds of stocks. Your money is automatically spread across many companies in different industries, which lowers the chance of one bad investment sinking your entire portfolio. This built-in balance is one of the reasons why index funds are often recommended for long-term investors looking for steady growth with less stress. So one of the biggest strengths of index funds is their long-term growth potential. Historically, they've delivered consistent and reliable returns over time. For example, the S&P 500, which is one of the most well-known market indexes, has averaged about 8 to 10% annual returns over the long haul. While there are ups and downs in the short term, the overall trend has been steady growth, making index funds a great choice for building wealth over time. Another major advantage of index funds is their low costs. Compared to actively managed funds, where fund managers try to beat the market, index funds simply track the performance of a market index. Because there's less hands-on management involved, the fees are much lower. Over time, these lower costs add up, helping you keep even more of your investment gains. Index funds also offer incredible simplicity. You don't need to spend hours researching individual stocks or trying to predict market trends. Instead, you just invest in an index fund and let the market do the work for you. It's a set it and forget it approach that still gives you exposure to a diverse mix of companies, making it perfect for busy investors or those who just prefer a hands-off strategy. So when you combine steady long-term growth, low fees, and ease of use, it's easy to see why index funds are so popular. They offer a stress-free way to grow your money and build wealth without needing to become a stock market expert. For many investors, index funds provide the perfect balance of simplicity and performance. Investing in individual stocks can be exciting, but can also come with a lot of risk. When you pick individual stocks, you're choosing specific companies to invest in, hoping that their value will grow over time. Unlike index funds, where your money is spread across many companies, your success depends on the performance of just a few stocks. This approach can lead to big wins, but it can also result in big losses if the companies you choose don't perform well. One of the biggest draws of picking stocks is the potential for higher returns. If you pick the right stock at the right time, your gains could far exceed the market average. We've all heard stories of early investors in companies like Apple or Amazon who made huge profits. But the flip side is also true. One wrong pick can cost you big time. A single company's poor performance or an unexpected downturn could have a major impact on your portfolio, making individual stocks a higher risk, higher reward strategy. To succeed with individual stocks, you need time, research, and knowledge. It's not just about guessing which companies will grow. You have to understand financial statements, follow industry trends, and evaluate a company's long-term potential. This takes a lot of effort and patience, and even with thorough research, there are no guarantees. For many people, the time, commitment, and complexity make stock picking a difficult strategy to maintain. While individual stocks offer exciting opportunities, they also require a high tolerance for risk and a willingness to stay informed. If you enjoy digging into financial data and tracking market trends, stock picking might be for you. But if you prefer a simpler, less time-consuming approach, index funds could be a better fit. When deciding between index funds and individual stocks, it's important to weigh the advantages and disadvantages of each approach. Index funds, like I mentioned earlier, offer simplicity, diversification, and lower costs, making them a stress-free, long-term investment. Because they spread your money across dozens or even hundreds of companies, they help reduce risk and provide steady, consistent growth over time. Now, on the other hand, individual stocks offer higher potential reward, but they also come with greater risks. If you pick the right company, your returns could far exceed the market average, but one bad pick could also lead to significant losses. Your risk tolerance and investment timeline also play a big role in choosing the right strategy. If you prefer stability and a hands-off approach, index funds may be the best fit. They require minimal research and tend to grow steadily over the long haul, making them a great option for busy investors or those who just don't want to stress over the market ups and downs. But if you're comfortable with risk, enjoy researching companies, and have time to track the market trends, individual stocks could work for you. This approach demands more involvement and expertise, but it also opens the doors to higher potential gains. It's also crucial to align your investment strategy with your financial goals. If you're saving for retirement or working towards long-term wealth, index funds are a solid choice. Their consistent growth and low fees make them perfect for long-term investing, especially if you're planning to hold your investments for years or even decades. But if you're looking for short-term growth or trying to capitalize on market opportunities, individual stocks might be worth exploring. Just remember, though, that the higher potential rewards come with greater risk, and you'll need to stay on top of your investments. Ultimately, the best approach depends on your comfort level, goals, and how much time you want to spend managing your investments. Some investors even choose a hybrid strategy, putting most of their money in index funds for stability while using a smaller portion for individual stocks to pursue higher gains. Whatever it is that you decide, the key is to stay informed and stay consistent, so your investment strategy can help you reach your financial goals. Once you've decided whether index funds or individual stocks fit your financial goals, the next step is to take action. If you're leaning towards index funds, start by looking into well-known options like VTI, which is Vanguard's Total Stock Market ETF, or VOO, which is Vanguard's S&P 500 ETF. These funds are going to offer you broad market exposure with low fees and consistent long-term performance, making them great choices for beginners and experienced investors alike. If you prefer individual stocks, start with companies that you know and believe in, brands you understand, and have confidence in their long-term growth. Doing this makes research easier and helps you stay informed about the businesses that you're already investing in. One of the easiest ways to start investing without stressing over market timing is what they call dollar cost averaging. That is where you invest a set amount regularly, no matter what the market's doing. Over time, this strategy helps smooth out the highs and lows and keeps you consistent. Next, you're going to want to choose a reputable investing platform to manage your investments. Vanguard, Fidelity, and Charles Schwab are all well-established, trusted options that offer low fees, strong customer service, and user-friendly tools for both index fund investing and for individual stock trading. These platforms also provide educational resources and portfolio management tools, making it easier to track your progress and make informed decisions. So take some time to compare their features, like account minimums, trading fees, and investment options to find the one that fits your needs the best. But if you're feeling unsure or overwhelmed by your choices, consider consulting with a financial advisor. A qualified professional can help you create a personalized investment plan, assess your risk tolerance, and choose the right mix of assets for your goals. They can also guide you through market fluctuations, ensuring that you stay focused on your long-term strategy. While there's often a cost associated with financial advice, the peace of mind and expert insights can be well worth the investment, especially if you're just starting out. Taking the first step toward investing can feel pretty intimidating, but the sooner you start, the sooner your money's going to grow. Whether you choose index funds for simplicity and for steady growth, or you choose individual stocks for the higher potential returns, the most important thing is to get started and to stay consistent. Over time, smart, disciplined investing is going to help you build wealth and achieve your financial goals. At the end of the day, the best investment strategy is the one that you can stick with. Whether you choose the simplicity and steady growth of index funds or the higher risk, higher reward potential of individual stocks, what matters the most is getting started and staying consistent. The sooner you begin, the more time your money has to grow, and time is one of the most powerful tools in building your wealth. And also remember, you don't have to choose just one path. Many successful investors use a mix of both, relying on the index funds for long-term stability and using a smaller portion of their portfolio to explore individual stocks. If you're just starting out, I recommend starting with index funds. They're simple, low cost, and proven to grow over time. And once you become more comfortable, you can start adding individual stocks if you want to take on a little bit more risk. So which approach do you prefer, index funds or individual stocks? Or do you mix both? Let me know in the comments below. I'd love to hear your strategy. Whatever approach you take, though, stay focused on your financial goals. Keep learning and invest with confidence. Consistency and patience will take you farther than trying to time the market or chasing quick wins. Now's the time to take action. Your future self is going to thank you. If you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, check out this video here. And also make sure to subscribe. Thank you for watching. I'll see you in the next one.